Hey, let's turn our attention to the world of oil. We just talked Canadian dollar with Michael Levy, but so pleased to welcome back to the show Josef Schachter, Schachter Asset Management. Joseph, let me start by just saying I'm just so glad your health has returned. You're back with us on Money Talk. All's right with the world.
Yes, it is. Thank you so much, and thank you for your good wishes when I had my recovery. But I'm fully recovered and and back in action, and there's a lot going on in the oil patches. We'll find out through our discussion in the next hour.
Now let's start off with, we've had this big bounce into the $50 range, ostensibly because we've got yet another proposal that, yes, they're going to meet in November, and OPEC may cut their production, Russia may cut their production, et cetera, et cetera. I mean, it's an old story. We've heard this, we've been in this like Groundhog Day. We've been in this one a few times before, but clearly, at least traders believed it this time.
Yeah, and we've done this about 6 or 7 times, and this sector moves very, very quickly. And just to go a little recap, we turned bearish in the first quarter of 2014, and at our 2014, and at the World Outlook Financial Conference that year, we said the sell word, and we reiterated it a number of times through that year. There was a decent bounce from tax loss selling in 2015 into 2016, and we reiterated again the sell thing. And again, there's 3 parts to it. There's supply, there's demand, and there's inventory. And we had supply that was growing. We had demand that was weakening. China was growing at 9%, now 6%. Europe, of course, negative growth rates. Japan, negative growth rates. And then inventories kept on building through 2014 and 2015. And then in December of 2015, during tax loss window, we turned bullish. And at the World Outlook Financial Conference in January 31st of 2016, we were banging the table, say, buy, buy, buy. We've had a fabulous run. The price of oil's up almost a double from that 26.05 to 51.60 or so. We've had stocks that have doubled and tripled from the lows. And for those people who were at the World Outlook Financial Conference, I put up a table there, page 42, and people were able to get a copy of this. You had the CDs the team was, Nina and the team were having available to the attendees, and we put on that page 42 a lot of names from large caps to service sectors, especially E&P, dividend models, Maison covered names that I cover, large energy transportation companies like TransCanada and Enbridge. The big transportation companies went up 50%. The service sector went up 50%. And things like Birchcliff was 285. It's now 980. You've got names like Pengrowth that were 66 cents, went to 220. You had names like Enerplus that went from 268 to 970. Surge went from $1.40 to nearly $3. There were some fabulous returns for investors. The problem, though, is we're now getting back into the problem where the inventory is growing again, and OPEC, for all their talk of 32.5 million that they're talking about doing, they produced in the month of September, which data came out last week Wednesday, 33.4 million. Now, Saudi Arabia was producing 10.5. They say they're going down to 10.3, so there's 200,000 that will come out. But the call on OPEC in the fourth quarter is only 32.2, so there's 1.1 million barrels of production in excess by OPEC than is needed. So if you take out 200,000 from Saudi Arabia, that means there's still 900,000. And 4 countries are not part of the quota system under this new deal: Iran, Iraq, Libya, and Nigeria. And in the case of Iran, they're still planning to take their production number from 3.65 in September to 4 million. Iraq is talking about taking production to 6 million, and they have pipeline capacity to do 500,000 very quickly through Turkey. And then you have Libya, which, of course, had all those problems there. At one point, they were producing a few years ago 1.6 million. In August, they produced 270. In September, 363. And they're saying by the end of this year, there'll be 900,000 more, and then 1.2 million more by Q1. So you're going to have 2 million barrels coming in from countries that don't have any OPEC quota response. So even if Saudi does bring down the production to 10.3, we're going to have a 2 or 3 million barrel glut over the next, per day over the next 3 to 4 or 5 months until maybe some economic growth picks up. And the problem is there may be only 50 to 100 million barrels of storage left. In the States, maybe there's 40 or 50 million, and maybe the rest of the world about the same. The big issue is China's been a big buyer for a long time, and China now is full up, and their strategic reserve is full up, so that if you have 2 million barrels of excess capacity and you have only 100 million barrels of storage available in the world, you can see that in 50 days or so, we got a problem. And that is why I think price of oil will retreat again. I think we're going to probably come down to where we were in January, February. We're officially saying low 30s, but it's possible that we could even go lower than that. And that is going to give us the next buying opportunity. So if people are overinvested in using margin, I would sell. If people are overinvested and have high weightings and it's in a taxable account, then maybe use some option strategies to hedge your position. If you're in a non-taxable account like your RSP, my view would be go straight out sell. There's some negative ETFs you can buy to take advantage of a decline in the price of oil and oil stocks. But I think there's a 30 to 50% decline coming in front of us over the next 5 months. That is dangerous to your financial health. Be careful. And as Michael said, the Canadian dollar doesn't do well in lower oil prices.
And I want to just review how good your methodology has been, and we've been a big beneficiary. And I know you and I talked about a deflationary environment going back 3 years, and you said, you wait. We had oil, well over $100. You told us to sell. It bounces, goes all the way down to, I think it's about $42. Comes up to about 63. You said, sell it again. That led to that decline into 26. And now we've had 2 chances at this sort of $50-ish range, and as you say, it makes perfect sense to me. I don't see any kind of successful reduction in production. But this other side you've said, Joseph, I just want you to elaborate a bit on. People sort of don't get when oil can't be stored, when you've overproduced, so you got an extra million barrels or something lying around, it's got to be put somewhere. When those storage facilities fill up, that forces the oil onto the open market. They got nowhere else to do it. They got to sell it, and that's a big pressure.
Yeah, these OPEC countries like Libya are desperate for revenue because, of course, they have the 80-90% of the government revenue is from oil. So they had it shut because of the battle, the war that was going on there between the ISIS and insurgents against the government in Libya, and so you now have the production beginning to recover, and they're desperate for revenue so that they can pay salaries, they can pay health care, they can fund their hospitals, their education system. So they're not going to stop producing, even if the price of oil goes down, 10 or $15. And the storage last week, the EIA showed that the storage in the States grew by 4.8 million. So, we can see that the U.S. took a big bunch of it, and over the next number of weeks, I expect those numbers to be 3 to 5 million a week on some weeks, and maybe even some weeks we see the U.S. take 8 or 10, because the U.S. has about 50 million barrels available of storage. But I don't think the oil companies, the refiners, want to be buying oil at 50 when they think it's going to go to 30. So their view is probably going to be, let's wait until the price comes down. And so as inventories build and the price comes down, it could come down very quickly. If you recall, in October of last year, we were looking at oil at $50, and in February it was 26. So things can fall very, very quickly. And my view is that we're in one of those windows again, where the price of oil is going to retreat as right now everybody's saying OPEC's got this done. We've got a win here. The supply and demand are going to be in balance. Well, number one, that's not going to be true. We're going to find out that EIA as the OPEC report showed last week, that they're producing more, and whoever can produce who's not part of the quota system is raising production as much as they can, and they don't have any limits on them. The countries that are asking for this deal are the ones who can't raise production. Countries like Algeria and Venezuela, which have desperate problems and can't raise production, they're the ones pushing for a deal. The reality is, the guys who can raise production, all except for Saudi, are doing that. And so once we end up with the last of the space being full up in the next few months, that's when, of course, the super contango could come back up, and the price between the front month and a year from now could widen to double digits like it did in 2008, 2009.
A good reminder how fast things move. for people when you look at these events coming out. Josef Schachter is my guest, Schachter Asset Management. We'll be back with him in just a moment. There's so much. Okay, so if we're going to go down into that period, are we going to recover quickly? People have a tendency to see things in terms of V bottoms. I'll ask Josef about that when we come back right here on the Money Talks Network. I want to remind you, if you go to moneytalks.net, you can click on the banner on the right-hand side there. It's Options Education Day tomorrow in Calgary. It's free if you go through moneytalks.net. Just give it a click. You can see the information there. It starts at 9 o'clock tomorrow morning. On the line with me right now, very pleased to welcome back to our show, I've got Josef Schachter. We're talking about the oil market, and there's no shortage of things to talk about in that regard, especially if you anticipate a decline there. Let's say we decline, and I'm with you on that, Josef, we decline, as you say, into the last of this quarter and the beginning of the first quarter 2017. Are you expecting sort of a V-bottom kind of approach, a very quick recovery into that cycle?
Historically we've had pretty decent recoveries, but this time I'm a little more pessimistic, and the reason is that once we get through the U.S. election, and you've talked quite a bit about it today, about some of the issues of the craziness and the stupid focus of the media versus the facts. I'll throw out one fact that hasn't been talked about. The U.S. debt this past year, everybody talks about the budget deficit being $600 billion. But in a seventh year of an economic recovery, they added $1.7 trillion in debt to the U.S. economy.
Yeah, it's a disaster waiting to happen there. And then you throw on the entitlement stuff. I'm on record as saying, what I think the media's missed, and a lot of people have missed, is they may not like Mr. Trump, but they shouldn't ignore that he is sort of the focal point for a massive group of people who are disenchanted with the system. And if you think we've got disenchantment now, wait till about 2018 is my guess. You're going to see pension problems hit like Illinois. Just a number back at you, Josef. I'll do it in my shocking stat. What the sense of what's going on in the pension system in the U.S., especially at the state and municipal level. But you're right. That's another monster thing. And there are a few other kind of problems, elephants in the room awaiting us that we have to also overcome. It's not just sort of a couple of dynamics. There's other things going on outside.
Yeah, there's two things that I'm watching right now that bother me. One, while the Federal Reserve is still talking about maybe raising rates, maybe not raising rates, the market is doing it for them. Interest rates are up 30, 40 basis points already. Mm-hmm. And if we go back to 200, 150 basis points more, and we go to 3% yields in the United States, investors in fixed income are going to see, if they have long maturities and long duration, those bonds are going to get hit severely in price. What bothers me is that in 2000, we had a technology bubble and the stock market bubble, and the market cracked. In 08-09, we had a housing bubble and a stock market bubble, and we had a severe crack, as everyone knows. This time we have three bubbles. We have a stock market bubble where valuations are at excess because of low interest rates, and dividend-yielding stocks are trading at the levels never seen before on a PE basis, and whatever other price to cash flow, whatever measurement you want to use, price to book. And we also have the housing bubble, and then the worst one the largest market of them all is the bond market. And bond prices have gone to the ridiculous levels on the high side and yields on the low side because the biggest borrower, the least attractive borrower, is getting the lowest interest rates because the central banks have shafted the system with what people are calling Ponzi-nomics, giving governments, who are the most inefficient users of capital and have the biggest debt loads, which you would say should deserve to pay massively high rates for the risk levels attached to it, they're getting the cheapest rates. Now, central banks now are beginning to realize that quantitative isn't working, especially in Europe and Japan, because the negative yields is like a tax on the on deposits of the banks, tax on depositors as well, and the spread business is dead. And what I'm concerned about, and I'm watching very carefully now, is the banking problem in Europe. And banks like Deutsche Bank, Commerzbank, Monte dei Paschi, the oldest bank in the world. Mm-hmm. Japanese banks, it's the British banks, Portugal, France, Italy, you name it all. All of the banks there are not financially viable given what's going on with negative interest rates. And just using the example of Deutsche Bank, it is multiples of the problem of Lehman. And so in the 2008-2009 problem, the central banks had deleveraged balance sheets, and they were the ones who could come to the rescue. Today, they have massively over-leveraged balance sheets. And the Deutsche Bank situation alone is multiples of the problem of Lehman, and it's not just one institution. The leverage ratio at Deutsche Bank is 28 to 1, so they have like less than 3% capital there. Their derivative book is 46 trillion versus Lehman's, which was 35 trillion. And the GDP of the United States in 2008, when this happened, was 14.5. So the leverage of Lehman to the U.S. economy was a staggering 2.4 times.
Yeah, no.
Deutsche Bank is 13.5 times the $3.4 trillion today German economy. So Deutsche Bank goes down, it becomes a massive problem.
Now, just a couple of things on that. One, I just got to say I'm proud of the fact that about 3 years ago I did an editorial saying that the central banks don't understand having record low interest rate is actually deflationary. And they now maybe start cluing into that. But we've been saying that on this show for 3 years. It's absolutely increasing deflation. But very quickly, Joseph, for the minute, what you've just described, though, is further impetus to the downside. But it impacts the recovery side.
It does, because if we have a financial crisis, and this time there is no savior, and we have to go through the liquidation of the weak entities. Remember, Dom Petroleum went under, in the late 1980s, even though 81, 82 is where we had the collapse in oil prices.
Yeah.
We're going to see potentially, because if you have to sell and you have margin calls, you've got to sell whatever it is. Just take a look at Royal Bank, what happened to it in 2008, 2009. Look at Citibank, look at Bank of America. The banking sector got beat up. Magna, you pick the name of the stock, pull out the chart for 2008, 2009. There were massacres across the board. This time, though, the recovery may not be as quick. So my view is that while I have an official target based on fundamentals of 30 to 34 for the first quarter now of 2017 for the price of oil, the problem is if we have a liquidity crisis and margin calls come in every other asset class, oil
could get much worse.
Simply because it is liquid enough that people can get out of, and that could drive prices even lower, which means that between December, when we have tax loss season, and the end of Q1, there's going to be a massive fall in the prices of everything, and there's going to be a fabulous buying opportunity. So that's why I'm recommending.
Okay, well, I got to leave it. Sorry, Joseph, I got to leave it there. I'm going to see you at the World Outlook Conference. Wonderful to have you back on the show. I'll be back with the shocking stat.